In our economics class at this moment, we shall be treating money. And under money, we will try to look at the definition of money, functions of money. We'll also treat what we call supply of money and demand for money, as well as quantity theory of money. Money. This is anything which is generally acceptable as a medium of exchange, settlement of debt, and other financial obligations. So when we are talking about money, money can be anything, but once it is generally accepted as a medium of exchange, then it becomes money. Or using in settle debt and carry out other financial obligations. This is what we call money. So money must be something that a society accepts as a medium of exchange. Functions of money. Number one, medium of exchange. Money serves as a medium of exchange. That is, all commodities are exchanged for money. And you can also exchange money for commodities. So if a society can abroad a thing, it can be commodity, irrespective of whatever they take as a word, as money, then it serves as a medium of exchange. Number two, units of account. With the help of money, it makes accounting possible because the value of goods and services are measured in terms of money. That is, if you want to measure a commodity or a service, you measure it in terms of money. That's why we say money is a unit or serves as a unit of account. The third one, measure of value. That is, money serves as a yardstick for measuring and comparing the worth of a commodity or the worth of goods and services. When you have a commodity or you have a service to render, you must understand what that service or commodity worth. So with the help of money, we can compare and we can measure the worth of commodities. Number four, store of value. That is, money serves as a store of value. It is a good store of value because wealth can be stored for future use. But for us to store wealth for future use, we need to understand the level of inflation in that economy. A situation where there is inflation, then what we call store of value will be a problem because the value will have reduced before we now use it in future. So when there is no inflation, the money store or save retain the value of money for many years. That is, when there is no inflation, money store or save retain its value for many years. But where there is inflation, it won't be able to restore or retain the value for many years. Then the last one, standard of deferred payment. That is, when you acquire a commodity on credit or a service on credit, you can postpone the payment to a certain period. That is, having known the worth of that service, right, you'll be able to postpone the payment. So with the help of money, goods and services can be bought on credit and where payment will be made in future dates. So that's why I say money serves as standard of deferred payments. I will explain what we mean by money and the reason why people are trying to have money. Then what do we mean by demand for money? Demand for money, this is the total amount which all individuals in an economy wish for various reasons to hold. Say, as an individual, you like to hold money for one reason or the other. So the number of people that we have in the economy, right, they all desire to hold money for one reason or the other. That is, it implies the desire to hold money, keeping one's resources or wealth in liquid form rather than investing the money. So when we are desiring to hold money, that is to say, we are not willing to invest with the money, but to hold the money in liquid form. To hold the money in liquid form. That's what we call demand for money. So the next one we are going to look at motive or reason for demand for money. Now, as an individual, you desire to hold money for one reason or the other. But we believe that when you are desiring to hold money for one reason or the other, you have just three reasons for holding money, or three motives of holding money. And the three motives are transactionary motive, precautionary motive, and speculative motive. What do you mean by these three motives? The first one, transactionary motive. When we say transactionary motive, it is a way where people are demanding for money in order to carry out their daily transaction, their daily needs. No one blessed day that each and everyone will not be desiring to hold money in order to spend, maybe for food, maybe on transport, and so on and so forth. So the money that you cannot avoid, the spending that you cannot avoid in a day, so such money is called transactionary motive, that is transactionary demand for money. The second one, precautionary motive. Here, you don't have the desire to hold the money for such reason, but you cannot avoid it, either within a week or within a month or within a year. So when you say precautionary motive, we are talking about expenditure that are unexpected, things such as sickness, such as unexpected visitors, and so on and so forth. All these cannot be expected. So in a situation where people are demanding for this, it implies precautionary motive, because they desire to hold money in order to meet unexpected expenditure or unexpected contingency that we mentioned as sickness, unexpected visitor. Something can happen to your car at any time. All these reasons are behind why people are holding money, that we call precautionary demand for money or precautionary motive for holding money. The last one, speculative motive, is also reason for holding money, that is demanding for money. Right? When you must have met your daily need, your daily expenditure, likewise unexpected expenditure, you even want to hold money in order to get more. That is, investing in an area that will yield you interest, maybe by buying shares or by buying bonds, or keeping the money in the bank because you have seen interest in it. So when we're talking about speculative demand for money, we are talking about demand for money in expectation of future trend in interest rate as well as prices in securities. So when you see that in future there will be an increase in interest rate, you desire to hold money for that in order to earn. But if you see that there is no increase in interest rate, you will not go into speculative demand for money. Not only that, if you observe that there is an increase in prices of shares, then you may have a desire to hold money here, right? So that you can gain from the share of the company or from the bond that the government issues. So when we are talking about speculative demand for money, it implies a situation where people are desiring to hold money in order to make more money. Supply of money. This is the total amount of money available for you in the economy at a given period of time. It involves the currency in the form of banknotes and coins circulating outside the banking system, as well as bank deposits in current account, which can be withdrawn by check. So we are talking about supply of money. We are looking at the volume of money in the circulation that can be in the form of banknotes, that can be in form of coins that we have in the circulation. Likewise, the account that we have with our commercial bank, that is the bank deposit that we call current account. All these, summation of all this, make what we call supply of money in an economy. Factors affecting supply of money. Number one, bank rate. What do we have bank rate? Bank rate implies the rate at which the central bank carry out lending and borrowing with commercial bank. It is the rate at which commercial bank can borrow and carry out lending. Now, how is it affecting supply? If there is an increase in bank rate, that is the rate at which the commercial bank can borrow from central bank, the rate at which commercial banks can borrow from central bank. If it's very high, then supply of money will reduce. So there is an inverse relationship between bank rate and supply of money. But if you want to increase supply of money, so the central bank will reduce the bank rates, so that it will be easier for commercial bank to get lending and borrowing easier. Number 2, cash reserve. I want to say cash reserve, it can also be called cash ratio. That is, we are talking about the percentage at which commercial banks are allowed to deposit with central bank. That is the percentage of deposit commercial banks are expected to keep with central bank. So every commercial bank is expected to keep certain percentage with central bank. So this percentage is what we call cash ratio or cash reserve, and it has an effect on supply of money. When there is an increase in cash reserve or cash ratio, it means commercial bank will have less amount of money to give to their customer. So there is an inverse relationship between cash reserve and supply of money. The higher the cash reserve that the commercial bank have with central bank, the lower the supply of money. The third one we call it demand for excess reserve. This, when commercial bank demand for excess reserve, the supply of money will increase. So this one has a positive effect on supply of money. So that is, the more commercial bank demand for excess reserve, the supply of money will surely will increase. Then the fourth one we call it total reserve of the central bank. The higher the total reserve of central bank, the higher the supply of money that we have in the circulation. So it has a positive relationship with supply of money. And the last one we call it economic situation. Economic situation can either be in inflation period or deflation period. Where an economy is having inflation, then the central bank will reduce the supply of money. But during deflation, the central bank will increase the supply of money. So the inflation has something to do with supply of money. That is, the relationship between economic situation and supply of money depends on the situation the economy is having. If it's inflation or deflation, as I've said, where it is inflation, supply of money will be reduced by central bank. But where it is a deflation, the supply of money will be increased by central bank. Quantity theory of money. This shows the relationship between the quantity of money in circulation in an economy and the price level. This, when we are talking about quantity theory of money, we are looking at the relationship between the quantity of money in the circulation and the price level. And what are we trying to understand? It explains the disequilibrium between quantity of money supply and demand for money. So what the quantity of money trying to let us understand is just to understand the disequilibrium between supply of money and demand for money. So the two are not at equilibrium. That is, supply of money is not equal to demand for money. So the two are at disequilibrium. That's what quantity demand of money is trying to let us understand, that if there is excess supply of money over demand for money, then what is going to happen? People will spend the surplus on currently produced goods. Truly, when you have surplus of money in your hand, you are going to spend it, but something is going to happen, and what is that? It will lead to increase in price level. That is, if goods and services are not increased with the increase in the supply of money, prices of goods and services will go up because supply of money is greater than demand for money. So that is one of the areas that quantity theory of money is trying to let us understand. Let's move further. If there is excess demand for money over supply of money, what is going to happen? People will reduce their expenditure on goods, which will reduce the price level. Because we've said it, demand and supply are not at equilibrium. But a situation where demand is demand for money is more than supply of money. So people will reduce their expenditure. As the total expenditure is reducing, automatically there will be a reduction in the price level. The theory further indicates that there is relationship between average price level, quantity of money in the circulation, the rate at which money circulates, and the quantity of available goods in the economy. We are going to demonstrate this using mathematical aspects. Using Fisher equation, we want to look at mathematical aspect that we have under quantity theory of money. The equation we are going to use is what we call Fisher equation. Now, Fisher equation, that is MV equal PT. MV equal PT. First of all, what do you mean by MV? MV indicates money supply. PT indicates demand for money. So it's like we multiply M times V to give us money supply, and we multiply P by T to give us demand for money. So let's define the symbols. M implies total amount of money in circulation. V implies velocity of circulation. Now P indicates price level, while T implies total transaction over the given period. Now we have to find the symbol. We want to understand one or two things in this equation. That's assuming we hold velocity of circulation constant, and we also hold total transaction over the given period constant. Something is going to happen between M and V. M is what we call amount of money in circulation. P is what we call price level. If there's an increase in M that we call amount of money in circulation, there will also be an increase in P that we call price level. So what are we saying here is that increase in circulation, increase in money in circulation will lead to corresponding increase in price. That's what we are trying to analyze. That once there's an increase in money in circulation, definitely there will be an increase in the price level of goods and services that we have to buy in that economy. So that's what quantity theory of money is trying to tell us. That's why we said it's talking about the relationship between quantity of money in circulation and the price level in an economy. Examples. Question 1. Money supply at any given point in time refers to A. Banknotes, coins, and demand deposits. B. Notes and coins only. C. Money received as gifts. D. Minted money. The right answer is A. Banknotes, coins, and demand deposits. Question 2. Which of the following are reasons for holding money instead of investing it? Roman figure 1. Transaction motive. Roman figure 2. Precautionary motive. Roman figure 3. Speculative motive. Roman figure 4. Liquidity motive. A. Roman figure 1 and Roman figure 2 only. B. Roman figure 1 and Roman figure 3 only. C. Roman figure 1, Roman figure 2 and Roman figure 3 only. D. Roman figure 1, Roman figure 2 and Roman figure 4 only. The right answer is C. Roman figure 1, which is transaction motive. Roman figure 2, which is a precautionary motive. Roman figure 3, which is a speculative motive. So the right answer is C. Question 3. Which of the following is a function of money? It is A. Portable. B. A standard for deferred payment. C. Generally acceptable. D. Relatively stable in value. The right answer is B. A standard for deferred payment is a function of money.